Rose, Longwood Currency Trading. It's early June of 2021. I always have to preface my videos with dates simply because it puts them into context with the times if you happen to be looking at charts or whatever and you want to kind of look at economic conditions of what's going on and what's generating me to talk about what I'm talking about. One of the things that I've been analyzing, not only from just general analysis, but also a computer simulation application that I'm currently writing on looking at trade entry. And so I thought I would take a short introductory swing at how I'm viewing what I want my simulation to tell me, what kind of feedback I want to get from that, and to kind of give you a different view of how to look at your trade entry analysis. It's a little different when you view it through the eyes of writing a simulation or sitting down with a piece of paper and writing stuff down, as opposed to actually looking at a live chart and trying to make determinations up from there. So that's sort of like what we're going to talk about, and I think it's a kind of a nice day. So maybe we'll walk around outside. I'd like to do that. So before we go out and wander around the yard with me extolling about my topic today, I think if you're new to the channel, you might wonder who the hell I am. So let me just briefly go over that, because I think it's important to understand not only the information that's coming out, but who's proposing that information. I've got a bachelor's degree in physics. I had a 33-year career as a senior software engineer designing pretty complex business applications. I've been in martial arts for 50 years. Real estate investment, 40 years, physics. I did a lot of different things. And all of that stuff has coalesced together, not to make me a better trader or a better real estate investor or whatever, but just to be more aware of not only the world, but myself. And so I'm not, my videos and stuff on currency trading don't talk about crazy shit. We try to bring the reality of life the way that it is into how we should view the currency trading based on somebody who's 72 years old and he's been around the corner a few times, okay? So that's the basic fundamental structure of all of the videos that I do, is my background, and you kind of sort of have to understand that. So, okay. So I've almost sloshed the last of my coffee out. I'm going to finish that, and then we'll go outside. So you stay in, Bo. You stay inside. Okay, so the reason for the video was to take a different view of looking at some trade entry analysis. We're going to take a look at that through the eyes of a computer programmer or somebody who's technically understanding of the world, as opposed to somebody who just sits down and is aware of fundamental analysis and technical analysis and whatever, and starts trading. Because you have to break things down a little bit differently, in order to do that. Now, one of the things that is preeminent, not only when you're doing computer analysis, but also just in general trading, is the whole concept of probability and statistics. Most videos that I've done, as well as what everybody else tends to do, is probability based. I look at a certain opportunity and I say, well, I've got a 50-50 jump ball chance that this is going to happen. Or I'm looking at something where I think that maybe it's a 30% chance, or I get a 60% chance, or whatever it is. Well, what are those based on? Well, they're based on a large sample size of events. I say sometimes, oh, well, I've got a 70% win rate. My win-to-loss ratio is 70%. The win-to-loss ratio can be an used statistic, and it can be undervalued by many as just another statistic. Look, you can have a 90%, and you can do this mathematically, you can have a 90% win rate and still lose money. Because if you're making $1 every time you win and you lose 10 bucks every time you lose, or 50 bucks every time you lose, it's not going to work out. So there's no magic statistic that you come to. But that win-loss ratio really is the driver behind how you can confidently view your trading once you get squared away and you kind of have a basic understanding of your trade mechanisms. One of the examples of probability that I've seen has been around a roulette wheel, and the probability of red or black should be 50-50, but then you have these odd number double knot things that throw the odds of winning off just a little bit for you, and just a little bit in favor of the casino, to the point where your odds of winning over the long run at roulette are it's not going to happen. And the example that I saw was someone who said, let's evaluate the probabilities of this casino game and what the expectation for your risk is in a casino, and you can calculate. I don't know exactly what the expectation of loss is on a roulette wheel. I don't give a shit because I don't play roulette. But I know it's pretty bad. Well, let's look at how your trade process itself, your trade entry and exit. The spread. You have a cost of doing business of the spread, the VIG, the bid-ask. So let's say your currency pair has a one pip spread. Some of them do, most of them will have a pip and a half. So you get 3/4 on the way in and 3/4 on the way out, 1.5. So to make it easy for the math, say you got a 1 pip spread. Or the example that he used was 3 pips. That's pretty big. If you're doing Turkish lira and Vietnam currency, you might get an 8 pip spread or something. He uses a 3. Let's go to a 3 pip spread, or a cost of business with slippage and all the rest of the stuff. You get 3 pips, okay? So if you're looking for a 10 pip profit, what he's saying is you need 13 pip movement in the price in order to beat the VIG. And in order to lose all your money, if you have a 10 pip stop, it only has to go 7 pips in your against you in order for you to lose 10 pips. So that differential, that spread, when you're talking about 10 pip profit target and a 10 pip loss, that spread differential it's like 30%. It's a hard nut to beat. There are ways of overcoming that, but it's a hard thing to beat. And that's why he particularly advocates we'll go to 100 pip profit target and a 100 pip loss. Now your spread of 3 pips it's just lost in the magnitude of the movement. Well, failure to understand that is that when you don't know what you're doing, if you're going to take a 100 pip risk, you're going to lose 100 pips about 5 times, 6 times, and you're going to win 2 or 3, and you're just not going to be ahead of that at all. So the analysis in looking at the currency trading, which is such a dynamic process, and isolating that spread risk to equate to the roulette, it makes it look a lot worse than it really is. Because in roulette, you only have this one ball, and it's only going to do one thing. It's going to, you throw it into the roulette wheel, and the roulette wheel spins. So the probability analysis that you do against a roulette wheel is easy. You can't do that same analysis against a currency trade. You can't. And you can't compare the risk of a roulette with a risk calculation done in the same way against a currency trade. You can't. We're moving around. It's too bright in the sun. It's supposed to get up to in the upper 80s today, so I thought I'd bring you out here with me to enjoy the weather. So look, when we're looking at the trade entry process as a probabilistic analysis, you gotta really, there's so many variables involved. There's the ATR, there's the distance to support resistance, there's the momentum of the price action, there's surrounding structural constructs that could provide, I don't know, whatever kind of obstacles that there are. Structural obstacles that I mean, there's just all kinds of different things that you could vary. You could say, well, I'm going to look at an ATR of 5 pips with a stop at 8, or I could look at a 10 pip stop, or I could say I have resistance to my rising price zone 20 pips away, 40 pips away, 5 pips away. There's all these different things that you can vary in a computer simulation, which in real time we tend to do those things instinctively when we get more skilled. But if you're just basing it on a couple of hundred trades, your instinct, that's not enough. And in a couple of hundred trades, you could go through a couple of fortunes. I've gone through quite a lot of money when I've failed and wiped out my accounts. The job of the computer engineer who's going to try to work on this stuff is the same job that I'm going to suggest that we as traders have to do in our study of the market, and in particular this analysis of trade entry. We have to start from the end. What do we want the trade to look like? A successful trade. That's where you start with. What does a successful trade look like? And the answer to that is it makes money. Okay, I'm going to sit down again. So it's obvious that the successful trade will make you money. Well, let's look at some parameters. If you're a longer term trader, what I'm going to say, you can extrapolate up. I'm not going to talk from a long-term basis because you can't extrapolate that down into the shorter time frames. I'm a day trader, and so everything I do is based on looking at my analysis on the hourly and the 15-minute chart, and then actually executing trades down on the 5-minute, managing those trades on the 5-minute and the 1-minute. So that I'm going to try to do my goal is to try to be done with my trading in a 2-hour period of time. I don't want to sit there all day. And I don't think anybody who's working or under the age, I'm 72, I don't think anybody under the age of 60 has the luxury of sitting around all day trading. I don't think you do. You know, you might have a couple hours in the evening or a couple hours in the morning in order to do that, even if even that. So what do you want to do? You want to put a trade on, you get up and you put a trade on, and you're in the shower, and then you come back and then you go, okay, I'm going to keep this trade on, I'll check it when I get to work. Well, that's just asinine and insanity. I've lost thousands of dollars by going out to get a fucking cup of coffee while I got a trade on. Don't even think about that. And unless you're willing to sit with that trade for days, and then it may work out. But let's not even get into that discussion. We're day trading. We're looking at short-term day trade stuff. So what does that successful trade look like? On average, when I sit down to trade, what could I expect to win? It's like if I go into a poker game and I'm used to playing with a $500 buy-in. Do I expect to come away from the table with $20,000? No. But if I made, I don't know, I go in with $500 and I come away with $100 profit. Walk in with 5, I go out with 6. I've made 20% on my money. That's really doable in a poker game, because you have so many diverse skills around the table. You go in the currency market, you don't have diverse skills. You got retail traders that are idiots that only form 15% of the daily volume, and 85% that are some of the smartest people in the world. You're not going to walk away with 20% on your bank on a day trade for sure, and you're not even going to do that on a long-term trade. You're not. George Soros might, but you're not. I'm not. What's reasonable then? What could you comfortably clip? Well, look at the market on a 5-minute chart with an ATR of 5. In a day's period of time on a currency trade, you say, well, I got a daily ATR of, say, it's 100 pips. I know some currencies have a 20 pip ATR daily, and some of them have 150. Let's say it's 100, which is reasonable. Most of the majors have that. Let's not get wound around the axle here. Let's keep the math simple. I'm on a 5-minute chart, and on a daily range, I've got 100 pips. And I want to trade for 2 out of those 24 hours. So I want to trade basically, 10% of the time, say 2 hours out of 24. So I'm only going to be trading about 10% of the time that market is open. So you got currency pair with 100 pip ATR. So in 24 hours, it means that you're moving about it's about 4 pips, right? 4 pips an hour. So in your 2-hour period, it's maybe 8 pips that you're going to see. But the period that you trade in, that 2 hours, it can't be in the middle of the night when nobody's there. It's got to be in an active period. Your active periods, if you're catching it at the open and going through, or if you have a cross pair that is open at the same time zone, you'll get probably 80% of your movement within that say 8-hour period of time. So you're getting 10% very easily instead of 8. 10 pips, 20 pips, 30 pips, 40 pips, probably 20 or 30, 40 pips within that 2-hour time frame, if you get your time frames right, and it's an active pair. So that's a good place to say, okay, I've got a 100 pip range that this thing is going to go through, and probably 30 or 40% of it is going to be done in the 2 hours that I'm going to pick. And if it doesn't have the volatility to do that, you just don't trade. So what are we looking at here? So the price is going to move in your 2 hours anywhere from 20 to 60 pips. That's certainly enough room to make it worthwhile to trade. Now, in that 2 hour period, will you get a retraction? Let's say you've got a 2 hours, you think your price is going to run, and you go back over the history of that currency pair, and you get the ATR of the time frame over a long period of time that you're trading, and let's say it's 50 pips or 40 pips of the 100, 50 pips. What does that price do? Is it always just going to go up 50 pips? Well, no, it's going to come back. Does it go up 50 pips and come down at 80? What's the average retracement that thing goes by? Big moves usually are followed by 50% retracements. Most moves are followed by 50% retracements. So if you're looking for a 50 pip move over that time frame, how many times is it going to retrace? Well, that depends on the on the volatility. I mean, it could not retrace at all. But in a 50 pip run, you might get 2. In a 2 hour period of time, you may get 2 reversals. So let's split it in half and say that every 20 pips, you're going to get a 10 pip pullback. Just as a for example. This is where the computer engineer sets out the playing field to establish what's going to work. If you can find a potential 25 or 30 pip run for that price to go from where it is, and there's all kinds of considerations to do that, but let's assume that you can get 25 or 30 pips, then somewhere in that range, let's say you'll get a 10 pip pullback. What's your win-loss? Well, in the beginning, you're gonna lose 80% of your trades, and you're only going to win a couple, so that really doesn't count. So you got to figure out where you're going to set your stop loss. So if things go really bad for you, if I have a 5 pip ATR and I set my stop at 8, that's an ATR and a half. That's not translatable up into the, if you're trading on the daily chart with 100 pips, I don't want to go 150 pip ATR. For, 150 pip risk. I don't want to do that. But down on the daily charts, on the 5-minute chart with a 5 pip ATR, an 8 pip stop is an ATR and a half. Everybody shits at me because I say, oh, your stop is too short, you're going to get a big retracement. Yeah, if you go in at the wrong time. It's not like throwing the little ball into the roulette wheel, or where your probabilities are static. They're not static. If I figure that price has a good enough volatility that it's going to go, and I'm pretty good at judging that, I ought to have a just less than a third of a 33% chance that the price is going to go against me. So 3 out of 10 times I'm going to lose 8 pips. That's 24 pips. So what do I need to make the other 7 times to come out 10 pips ahead? Well, I got to make 34. I got to make 30. I got to make 30 pips anyway, at a minimum, to beat the 24. Right? Let's say I'm 25 pips out with slippage, so I need 25 and 10. I need 35. I need to make 40 pips in 7 runs at the table. I need to make 40 pips. So in seven attempts. So does that work out? If you have a 67% chance of success, are you going to be able to average out over all of those trades that 40 pips that you need in order to get the 10 to open up? Well, that's a matter of managing your stop behind the trade, and it's a matter of how you manage how far you're going to let that price go before it starts to chatter and you're going to get a 10 pip pullback. You know, if you only get 4 or 5 pips in the black, and now it's time for a pullback because you didn't get in at the bottom, and now you're going to go that 8 pip down, you're going to get whacked. And so you have to be really good at judging when you're going to get into this thing if you're going to write this computer program. But what you're trying to do is write a computer program that makes you a success. Now, really what you want that computer program to do is over the 10 trades to have an average gain of 5 pips or 10 pips or whatever. So you have to take the 3 losses, which is 24 pips, and now you have to build up a scenario where within those 7 trades, you're going to accumulate what will be an average per trade win over the 10 trades of 5 pips or 3 pips. 3 pips times 7 on the winning trades is 21. So that's not including the other 10. 3 pips on the 10 is 30. That's really what you need to make in order to get a 3 pip per trade value. On your expectation, if you can say, oh, you're not going to get 10 pips, because then you'd have to be shooting for 40 pips, and your stop would have to be, you'd have to refigure everything out. What I'm trying to do is build a system that will only experience 1 or maybe at most 2 of those pullbacks where I may have to make the decision to exit in order to capture the amount of the value from the trade series that I'm really looking to accomplish. If I can grab 3 pips every time I trade, is 21 enough to beat the 24? Well, it isn't. I've got to grab at least 5 pips on each one of those 7 trades to get 35 pips, and now I've got my 10 pip gain over the 10 trades. But that's only 1 pip every time I trade. But you see how important the value of each pip is. So my computer simulation would say, what parameters do I need to set so that on average over 100,000 trades, the per trade pip value is 3 pips. That's the simulation that I got to build. And so when you're doing this by hand, you have to say, what skill level do I need to have in order to get this 3 pips a trade? Well, it's a win-loss ratio of 70%, but you don't have the 70% yet. But you can't change the framework of the system that you're building. You have to do it differently. You know, when I was a kid, I was 14 or 15 or whatever, and wearing military clothes was in vogue, and military jackets and stuff. So I went with a friend of mine down to the military supply store because I wanted to get one of those military coats. And so I went, and I was just a little guy. I was 123 pounds when I was in college, you know, so I wasn't a real big big guy. And so I go into this military store and I'm looking through the coats, and they're all, you know, a couple of sizes bigger than what I was, and they just look like tents on me. So the guy came over, he goes, "Can I help you?" And I go, "Yeah, I was wondering if you had one of these coats in a size that would fit me." And he looked at me and he goes, "Son, the Army don't build coats to fit the man. They build the men to fit the coats." But that stayed with me. I'm not trying to make the system fit my inadequacies. I've got to improve my inadequacies to match the characteristics of the system. And if I can get those skills to the point where I get to my, which is basically a break even, you know, the 4 pips, sometimes 428, you're getting really close to that, 4 pips on each winning trade would overcome the loss. That's your baseline. That's the absolute minimum that you'd need to do. What win-loss ratio does it take in order to get that? Well, you could get 7 out of 10. Well, what would you have to win if your win rate was 60%? Well, then you'd have to get maybe 8 pips on every trade. So you'd have to look at your trading time frame that you're on, and you'd have to say, what's reasonable pips to get out of this? I enter the trade and it goes in my favor, and before it has a chance to flip around and go, boom, I'm out. When that starts to chatter, I'm out, and I've got that required value. Then I simply look for the next trade and I go back in. And I do the same thing again. And consistently getting that maybe it's, let's say it's 8 pips instead of 4. I can't get 8 pips. I can't. Well, then you got to have a better than 60-40 win to loss. You can't change the system to match your skills. You're going to have to up your skill game to get a 70-30. Or maybe when you do your calculations, a 60-40 based on the ATR and all the other stuff, maybe that's going to work. So that's the application that I'm writing now, is I'm varying win-loss ratios, I'm varying ATR, I'm varying where all this other stuff, I'm holding my stop constant because I don't want to have too many variables. You know, 5 variables, 5 permutations of 5 variables is 325 different combinations you can put those variables in. That's just too much. So I'm experimenting with this and trying to get it down to 3 variables. And so that'll give me 12, about 15 or 17, I don't know what it is, do it in my head, different permutations, and I can easily run a computer program and get the best fit for that. But that's how a computer programmer would go about doing it. That's what we have to do as a trader. We have to go to the end. We have to go to the end of the game and see what that looks like. That's if you're a chess player and you read Jose Capablanca's book, Last Lectures. He starts off with just the 2 kings and a couple of pawns on the board to teach you how to move around and what the game is supposed to look like. This is how you capture the king, by moving the pawn down to the 8th square and make it a queen, and then you win. What happens when you've got a bishop and a couple of pawns, and your opponent has a bishop and a couple of pawns? How do you manage so you learn the game of chess by looking at what the end looks like. The end is capturing the king, and not that, oh, I'm going to open with a Roy LePage, or I'm going to defend with queen's pawn, or I'm going to have an Indian defense. No! What am I trying to do? I'm trying to capture the king. Okay, what's the best way to capture the king when I got a rook and a bishop? What's the best way to capture a king when I got 2 knights? What's the best way to capture the king when I got a queen and 3 pawns? That's what you need to look at in your trading analysis of your trade entry. What are the best parameters that I can vary, the simplest ones, to create the best conditions for me to have a successful outcome. That gives you your trade entry, okay? Well, that's what I teach anyway when I work with a student. Most of them don't want to do the work in order to figure this stuff out. That's their problem. What can I do? Can't do anything more than that. This is the way you got to do it. If you're trying to read a book or watch a video and learn from these guys that are protecting their money instead of trying to make their money grow, you're not going to make that account grow. You're going to protect it, and you'll make an okay amount of money, but you're not going to grow that account. You're not going to be able to maximize the value because you don't know the component pieces, the parameters. You say, well, I'm not getting as much out of my trade as I need to, and I can't seem to increase my win-to-loss ratio. I'm doing the best that I can. Great. Figure out which parameter you can improve and change that and make that work. Maybe it's as simple as bringing your short stop down just a little bit to give the price a little more room to breathe so it has time to go off because you're not quite good enough at judging the trade entry, so you need that room to breathe. I know a lot of guys that do that. They're trading on a 5-minute chart and they give it a 20 pip panic freeze, and they say, geez, that improves my win-loss ratio to the point where that 20 pip loss usually doesn't get hit, and when it does get hit, it's 20 pips. And I've lost once 20 pips, but I've gained 65 in my wins. It makes a lot of sense. I think that it's better to focus on good trading and good trade entry analysis so that you can then stage into the trade as it goes in your favor, rather than having the thing constantly in your mind. I'm prepared for it to go 20 pips or 18 pips wrong before it then turns around. Because the last thing you want to do is try to stage in to your trade as it's moving against you. If you're in the United States, the process of adding a trade here and then having to go back up to here and then getting out of that one trade, you can't do that in the United States. In Britain and other places where they don't have FIFO rules, you can do that kind of manipulation. You can go in and out on any one of the particular lots that you have on. Well, you can't do that in the United States, and you shouldn't, because that's just a scramble mess trying to do all that stuff anyway. But regardless of that, look realistically at what the capabilities are that you have and what parameters that you could change, and you're going to be successful. You'll be really successful. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.